Hello, ladies and gentlemen. Welcome to the show on this Friday, the 19th of June, 2020. Glad to have you guys here. Now, listen, I want to talk to all you gold bugs and silver bugs out there. And what I want to say is we all know that the world's central banks, including the Fed, are overprinting they're not actually printing it, but they create more digital currency units all the time. More than And as the economy starts to pick up, they can't back off the pedal. We all know this is going to lead to inflation. And that inflation is going to start, people are going to start losing confidence in the dollar, and it's going to lead to an economic upturn in the not too distant future. Once this virus starts to go into the back burner and it becomes less of an issue, then the economy is going to start to heat up again. Now, maybe not back to the extent that it was, but it's going to start to make a recovery. And the Fed's going to keep printing the money out there and keep pushing the money out there. And eventually what it's going to lead to is the lead-in period to hyperinflation, which is called the acceleration phase. And that's probably coming within a year, the acceleration phase. Okay, so you're saying to yourself, well, how does this apply to us gold bugs? Well, I'll tell you exactly how. When the hyperinflation really starts to get underway, it starts to get serious, it's going to lead to a situation, and they're already preparing for this, guys. All the central banks on earth are making their own versions of stable coins. Well, what a stable coin is, basically, is you've all heard of Fed coin, or some of you have heard of Fed coin. They'll probably call it the dollar, but basically what it is they're taking the technology that runs Bitcoin, the world's central banks, and they're imitating that technology, and they're going to make the new dollars into what's called a stable coin, which is it's like Bitcoin. They're going to Bitcoinize it. When the hyperinflation gets too bad, that's what they're going to do. But, they're going to be dealing with a situation at that point where people have totally lost faith. And this is why they have to make the stable coins, because people have lost faith in the fiat currencies, which are backed by nothing. So more than likely, there's a very strong possibility that these new stable coins that these central banks come up with are going to be backed by gold. A very high probability of it. In order to bring trust back in their currencies. But here's the ticket, guys. When they bring the stable coin out, it'll be the dollar. And it'll have good purchasing power because it's backed by gold. People will be forced to buy into it because really what they want to do is get rid of cash. So they'll buy into these stable coins, and it might be like 100 to 1. You might get one stable coin for 100 of your old dollars. But they're still going to have to create so many of these monetary units in order to run the system in these new stable coins. And if they're backed by gold, this means that they're going to have to make the ratio that the stable coin is backed by gold very small. In other words, we're probably looking at a gold price in the new stable coin of probably like $5,000 an ounce. They're going to have to break the gold price down into that small of an increment in order to make enough currency units of the new stable coin backed by gold, that the gold's probably going to be like $5,000 an ounce in the new stable coin. And the old dollar, it'll take 100 of them to buy one of your it'll take 100 of the, probably like 100, might even take 1,000 because of effects of hyperinflation. And so this means the central bank, in order to have the gold to back the new stable coins with, and all the central banks too, not just the American central bank, but all the central banks have to do the same thing, because it's going to be a worldwide hyperinflation. It could lead to tremendous short squeezes on gold and silver like we've never seen before, with these central banks gobbling it up to make a backing for their new digital currencies. And this is all going to happen rather quickly, you know. Okay, let's move into the markets now. Let's get the charts open right here, and let's take a look at the gold price today. It's up $20 on the day, 1743. Now, 1750 is a very important mark for gold. Can it break through 1750 and hold to the upside? It looks like we're heading towards 1750 right now, and we might test 1750. And this is exciting, that we might be able to break through 1750. Okay, let's take a look on silver. 1762 is up 26 cents on the day for silver today. So we're having a good day in gold and silver. Cryptocurrencies, 265 billion. Market cap with a Bitcoin dominance of 64.9%. And a Bitcoin price today of $9,350. Now let's take a look at the Dow Jones Industrial Average. She's down 147 points today. 25,932. Now it was up earlier in the day, you know. I think the Dow has got used to now the idea of the Fed's monster stimulus packages. And what happens is they've gotten used to it awful fast, haven't they? And look, the Dow's going along sideways even with a downward turn to it. What happens if the Fed pulls away that stimulus? If the market's not going anywhere right now with all of that stimulus, amazing amounts of stimulus that they've pumped in for speculation in the markets, and if the market's not going anywhere, can you imagine what would happen if they tried to pull any of it away? They can't pull it away now at this point. If they want to keep these markets from, tanking, they got to keep that stimulus a-coming. Okay, let's take a look now at crude oil. 23 cents up today. 39.07 for crude oil. I can see a day. And I'm not talking 20 years from now either. I can see a day where crude oil is $200 a barrel. I can see that day. You know? Seriously. Let's take a look at U.S. Treasuries. U.S. Treasuries today, a long end of the yield curve's rising, but insignificantly. And the short end is falling. What we're looking at is a 10-year at 0.69, and the yields have risen less than 1 basis point, 1/3 of 1 basis point. And the U.S. 30-year at 1.47, and we're looking at a 1 basis point rise in yield on that, on the U.S. 30-year. Now let's look at the U.S. dollar index. 1 second till chart opens. 97.57. You know, all these people putting faith in the dollar, some of the biggest investors in the world who really know what's going on with everything here. Like Ray Dalio says, okay, cash is trash. And he's not just saying that to hear himself speak. He realizes that the paradigm that we're in right now, with all of the central banks having to be forced to print more and more and more and more, and you know that eventually this thing's going to start to turn around when bank lending starts to loosen up. So if we start to get a little bit of a recovery, you know, and then the banks start to lend money out again for projects and things, guy might want to build a new restaurant or whatever, you know, and so the bank makes a loan. Well, the banks, what do you call it? They have to keep a certain amount back, like I think it's 10%. They've lowered those restrictions on the banks. Reserve requirement restrictions. They've lowered the reserve requirements of the banks. So this makes it so the banks can lend out any amount of money that they want to lend out. But they are on the hook for it. So you know, they want to check and make sure. So the guy wants to borrow to build a restaurant, right? The bank creates that money from nothing. That's the real money multiplier. Once that starts kicking in, once the banks start loosening up their monetary policy again and start expanding the debt again, we're going to see oceans of money. And then the velocity of money is going to start to pick up, and we're going to start to enter into a little bit of a recovery that's going to work its way into a bigger recovery. And that is just before the doom strikes. That's what's going to push us into the hyperinflation. Look, it's not a bad economy. A bad economy does not create hyperinflation. Like we got right now, people losing jobs and everything else. We're safe. As long as that's going on, the economy is pretty safe because the Fed has control over that. They can just dump some more money in. Oh, they got a problem, you know? They dump more money in and problem solved. But once the hyperinflation starts, they can't solve that problem by dumping money. It just makes it worse. And what causes the hyperinflation is not a stalled out weak economy like we have right now. We're going to enter the danger zone when we start to come out of this virus and the economy starts to pick up. It's that hot economy that causes the hyperinflation. But what triggers that is banks creating too much money. That's what triggers a hot economy from becoming a hyperinflationary economy. That's what triggers it, is the banks making too much money. Well, we got the circumstances that are correct right now for that to happen. The central banks have just stimulated money and put tons of money out there for the other, and lowered reserve requirements and let these banks go crazy lending. And next thing you know, the velocity of money picks up. And the next thing you know, we are heading toward a hyperinflation. But you're going to see the economy pick up just before the hyperinflation. You're going to see the economy really heat up. That's when to beware. That's the trouble sign. That is the alarm flashing going off, is when the economy starts to really heat up again. And everybody starts working again. In fact, you see in every store, you'll see they'll put a sign up that says, we're hiring, help wanted. When you start to see those help wanted signs go up in all the stores and stuff, that's when we're headed toward the hyperinflation. When there's jobs galore, easy to get a job. Even a person that's down and out can get a job. When you see that happen, that's when to watch out for the hyperinflation. But right now, the way it is right now with a depressed economy like this, we're not heading toward hyperinflation. They can dump as much money as they want out there right now, and it's not going to create hyperinflation. But it will set the stage for hyperinflation in the not too distant future. And that's what we're headed toward. We're headed toward the economy starting to pick up again. I'm expecting it's probably going to pick up once we actually see this virus say bye-bye. Okay, and the virus starts to say bye-bye, then we start to see the economy start to pick back up. That's when you got to watch out. Anyway, listen, thank you guys for listening. Like and subscribe. Give me a thumbs up, and we'll catch you guys in the next show. Bye-bye.